Here's a good one. Today we're talking about the note investing downsides, which is such an important thing to understand so you can get over the uninformed optimism of a new venture and go right into informed optimism after understanding all of the risks that are associated with any particular asset class that you're getting into. And the first downside is that refinance or payoffs means you have to go back to work. With any transactional type of investment, you do need to keep your acquisition pipeline full. Whether it's rehabbing and fixing and flipping properties, where you have to always have those distressed properties in the pipeline to continue your business, you need to make sure that your acquisition efforts are perpetual. Now that's a big downside, and as a note investor, you do need to consider this for the longevity of your investment portfolio. We talked about this in the first Wednesday's video of the month about how you can diversify your portfolio to balance both yield and perpetual cash flow with things like rental properties. Next is deal flow can be tough to source. This is really why going back to work to have new acquisitions in your pipeline can be so difficult. Finding new opportunities that fit your investment objectives in the geographies that you're targeting can be difficult. So it's so important to have a network of sellers that you trust and can work with to find new opportunities. Another downside here is it's difficult to finance mortgage notes for leverage. Traditional real estate deals are very easy for banks to underwrite, and you can have leverage on your capital by having a bank finance a portion of your acquisitions. With mortgage notes, there are some rehypothecation strategies where you can work with a bank to finance and essentially hold the collateral in escrow with assignments of mortgage to their entity. In case you default, they can quickly obtain possession of the mortgage note asset through the assignment of mortgage process, but it's very complicated and not something that most banks are interested in pursuing. So it is easier to leverage other investment assets. Next, it's tough to navigate the licensing and regulation complexities. There are great companies like Cornerstone Licensing, which can show you the state-by-state breakdown of the licensing required across the country, or vehicles like a Delaware statutory trust, which can step into the provisions of a nationally chartered bank as your trustee to essentially sidestep all of those state level regulations and licensing as well. But it is important to consider when other real estate strategies or other investment strategies in general don't have those complexities right off the bat. Now, for a startup note investor, there are limits within each state to the amount of loans you can buy without licensing. Where I am in Pennsylvania, you can own up to 4 mortgage notes before getting a debt buyer license or structuring your entity as a Delaware statutory trust. So you can still get your feet wet without navigating all of these complexities, but it's important to understand those limitations as you begin your investment career. And then finally, there are many counterparties involved in the mortgage note investment process, more so than pretty much any other investment strategy. You're going to have a loan servicer. You're probably going to be dealing with attorneys and perhaps realtors if you're taking back REOs. You're working with door knockers and property preservation specialists. You may have a collateral custodian. There's many different counterparties, not to mention your loan sellers and other partners that you work with to finance or resolve your mortgage note deals. So you need to understand how to build a network of really competent counterparties, vendors who can get the job done and work with you in a way that monetizes non-performing loans or makes sure that your reperforming loans continue to pay every single month. Now, the good news is we resolve all of these downsides with membership in the Mortgage Note Mastermind group. We've got deal flow. We have trusted counterparties. We can teach you about that rehypothecation process or setting up a Delaware statutory trust to navigate licensing and regulations. And finally, we have a whole database of vendors that you can count on for the different counterparties you need to leverage to make this business work for you. So before you count it out as an investment strategy, mortgage notes with proper due diligence offer a very safe real estate centric investment as long as you have all the information going in. So continue to stay tuned on this channel for all the free information we can provide, along with FIXnotes.com for our free comprehensive mortgage note investing course so that you can be fully informed as you navigate the secondary mortgage market. I'll see you next Wednesday for our next episode.